Welcome back, everyone. I'm Rebecca Wallenfelsz, a partner at Chapman Cutler in the Trust and Estates Department. Joining me again today is Mike Jankowske. Mike is president of the Hamelind Group, which provides plan-giving resources and strategies to professional advisors like myself, donors, and non-for-profits. Prior to starting Hamelind, Mike was a financial planner who spent about 30 years helping clients rethink their assets and investments through a tax lens, and in particular, an income tax lens, as well as the estate tax lens, to help clients create what he called tax diversification among those assets and investments. So, Mike, welcome back.
Glad to be back again, Rebecca.
And so in this series of videos, you and I have been going through and talking about tax diversification. If you want to know more about that concept, see our prior videos. But today, the focus was going to be on a category that you call the taxable category, which sounds like kind of ominous, right? It's the taxable one. So would you tell us, though, briefly, what assets you think are in this category, and how should clients be thinking about this as an asset tax class?
Well, this is a very all-encompassing category. I'll give you three critical areas of what typically falls in this taxable category. First of all, it's a normal investment portfolio where if you buy stocks, bonds, whatever the case may be inside of your portfolio, okay, that's one particular thing to look at in terms of what's in this category. The second one is it could be any business interest you may have, all the way to a sole proprietorship, all the way up to a large corporation or multiple businesses that you own. And then last but not least is the category inside of the category, real estate, which could be personal, rental property, it could be commercial real estate, where those are all the different assets that have very similar, if not identical, characteristics in terms of what happens to you from an income tax perspective during your lifetime.
Yeah.
So that's the general category.
Yeah, and in that, we're talking about assets that might generate taxable income, and if sold, are subject to some kind of taxation.
Right. So, I mean, I call this category you pay as you go, and if you need more money, you're going to pay again. And so it's not like the tax qualified, tax deferred category where if you just keep it parked there, keep it parked there, and then until for such time you're forced to take the money out. This is more tactical about what you need to be doing in this category. And it may not be you're going to be trying to move money out of this category to something else, although it might make sense. But if I'm talking about paying as you go and still paying later, obviously if you die in this category, I know the estate planning part of your brain, Rebecca, says it's not a problem because if I die, my family, my heirs are going to have a step up in basis. They're not going to have any income taxes to deal with. They might have an estate tax to deal with. But when I hear that, I do like a little bit of a mock heart attack because I'm saying, why are you doing that to yourself while you're alive? So what's critical is important to understand is what do you do to counteract the income taxes along the way? What do you do at some point in time where you want to liquidate whether it's a business interest, whether it's an investment portfolio, or whether it's real estate of some sort? How do you avoid not only paying the taxes along the way, but also have an exit strategy, for lack of a better description, that doesn't hammer you as much on the back end when you want to sell off the asset, which is going to what we call, in most cases, the capital gain world. Yeah. So that's the part that's important about this category.
Yeah, and I like that comparison to the other category, particularly, for example, the tax deferred category, where, you know, your point about what happens when someone dies, like leaving your heirs an asset that's subject to income tax as well as estate tax. This category, when I leave it to heirs, it doesn't come with the same income tax burden, right? Because I get a step up in tax cost basis. But your point is that the taxation during my lifetime, while I own it, is what we have to consider.
Yeah, and there's a lot of contributing factors that what makes it a worse set of circumstances for income taxes along the way. Let me put it this way, just like on other sessions that we've done, you know, the longer you wait, okay, the bigger the problem, or what I call the mess you have to clean up. And that's not to say don't do what you're doing to build wealth here, because I will say that when people go up in wealth level in this country, this is the particular tax category where you see a dramatic increase in the disproportion of what's sitting in the taxable category versus the other categories we've talked about already. So it becomes challenging because you don't want to curtail the growth of your wealth in this category, but you want to frame what you're going to be doing, understand what you can do to counteract some of the taxes along the way, and more importantly, not get hit with the taxation at the back end of the deal.
Right, right. Because I think clients often think about assets in this category as I control the tax consequences, maybe not the revenue stream so much, by not selling, right? By simply hanging on to this asset. If I don't sell it, I don't have that tax liability, and I can control when I sell or not. So is that an incorrect way to think about this tax category?
No, it's absolutely 100% on target. And the sad part is human nature gets in the way. People tend to, when it comes to a point in time where something drops in your lap, like let's say you own a business, and all of a sudden you have somebody that pops in and wants to give you an offer you can't refuse to buy the business from you. You have a limited amount of time to do much of anything at all to counteract what you're going to be experiencing in capital gains taxes, much less be structuring in such a way where you can take advantage of some of the strategies to avoid the capital gains if you're going to liquidate. So how do you marry the tax along the way with how you avoid the capital gains? And that's going to be an interesting discussion related to the mystery category, which is the tax shelter category, which allows you techniques to counteract some taxes in each one of these particular tax categories that you don't want to pay taxes. Now, with the taxable bucket, it may not mean that you're going to move stuff out of the taxable bucket. It may mean you're repositioning holdings in there to create cash. It could be you could move money over to trusts, which we'll talk about later, okay, which could be a very valuable tool to use in this particular category. But suffice to say, the longer you wait to kind of figure out what you can do in each one of these categories, the more troublesome it is for your professionals to be able to do this, which, by the way, as we always say in these videos, you have to make sure that you collaborate with your professionals way ahead of time, meaning your wonderful estate planning attorney, your CPA, your financial advisor, to start formulating a long-term game plan for what you're going to do with the particular aspects of the wealth in the bucket. Like, for example, most business owners don't realize that sometimes the entity that they pick is not a good entity to avoid capital gains on the back end. Okay. Yeah. And in many cases, because of that, they also lose some marketability for what they're going to get in fair market value to begin with. So you could take the concept of becoming more marketable in your business and at the same time have the ability to do a way to avoid the capital gains as part of a strategy all in one breath. With investment portfolios, that's a different ballgame. That's pretty vanilla in terms of what you can do, because you can pick different aspects of investments inside of the portfolio to counteract some capital gains. You can do all kinds of cool stuff like offsetting gains with losses. Okay, there's things you can do there where it's more mobile in your strategy. The real estate is another challenge because depending upon the entity and the real estate. And here's the big factor. The X factor is, do you have debt against the real estate? A lot of times if there's debt against the real estate, what happens is it restricts what you can do. So in many cases, we have advised donors / professionals the idea that you realign your debt. If you're going to sell an asset, borrow money from another category in this category to keep the real estate debt free. So you've got the maneuverability to do the things that we're going to talk about in the tax shelter category. But if you do that, what's going to happen is you're going to have more net cash for yourself that you want to create. The hardest part about this is back to the whole time of life cycle. The longer you wait, the more troublesome it is to recreate or redesign what you're doing. So, and obviously your question's always been in prior videos. Well, what happens if, and we're talking about being older, what happens if I'm younger and I'm just getting started and I want to build up assets in this category? Well, is that your question, Rebecca?
It was going to be my question.
Okay, I'm sorry. Did I jump ahead of you? I'm so
No,
sorry. I
just
know you
fine.
like to talk too, but I have this problem. I'm going to a 12-step program to try and not talk as much, but I'm working on it. But when you start off, you need to understand at the very beginning, not only about what a professional advises you on the entity type that you're going to create and how you build your business, what the end game would be that you would evolve over time. A perfect example in a business is typically smaller business are basically the person that's the owner. Their fair marketability of the business is almost non-existent because they're a core item in the business. What's critical is that somebody that owns their own business becomes less important to the nature of the business. The less relevant you are, the more marketability you get, the more opportunities for somebody buying you at a higher market value, the more opportunities to counteract capital gains. So when you start a business, don't be entrenched in the entity that your professional advisor advises you on unless you talk through how this could evolve over time.
Yep.
And that's true for the real estate. Okay. People like to use leverage and debt to build real estate. Perfectly cool. That makes all the sense in the world. But at some point, you want to start to partition some of your real estate into non-debt owned real estate. And that way you've got some options if you need to transition. I would even go so far that some of the tax strategies in the next video would allow you to leverage and grow your wealth more in real estate if you utilize certain trusts. Instead of taking an outright cash sale and thinking you can use a 1031 exchange, which is a legal thing and tax thing about where you can just exchange the real estate to another piece of real estate and you kick the can down the road in terms of what happens to capital gains. Why not counteract the taxes on the capital gain on a real estate holding you want to sell, and then in turn use debt at a higher level to buy more real estate rather than just transitioning equity from one holding to another? It's stuff like this that people don't think about to the degree they should. And like anything else, professionals need to give a long-term vision or look to a young person to know what this could evolve into. So they're cognizant of what's going on, and you constantly check it along the way to see whether or not you need to start to do some of the tactics we're going to go about in the tax shelter category.
Right. Because coming to your advisors 3 months after you've sold an asset and asking then, how do I counteract the tax liability I've just incurred? Maybe a little bit late.
Well, I call that in my world tax reacting, and
Yes.
that does little or no good. Tax planning by definition is not taking even 12 months before you're contemplating selling something in this category. It's a number of years. And I mean, the longer you have to understand how to frame things, the easier it is for you to do a transaction when the time comes, because you're never going to know. You're
Right.
never going to know when somebody's going to want to buy your real estate business. You're never going to know when you're going to need cash from a personal perspective. And or in case of most people who have businesses in real estate, they do burn out. They do say enough is enough. Okay. And they want to get out. And then they're stuck with the albatross of how do I do this? Every time I look at that, oh my word, I'm going to pay so much in taxes. Maybe I took some losses along the way in my business, passive losses with real estate, and all of a sudden you're looking at a very low basis, high capital gain item, which could create all kinds of chaos in your world. What do you do to be able to counteract that? And again, if you take a piece of real estate, sell it, and avoid capital gains taxes to some degree, most of the strategies that we've used allow that person to keep a portion of their wealth still in the taxable category where it's liquid. And then another portion goes into a trust where it could be used as a future cash flow pool of money that you could tap into, which is more tax favored. this is a little tidbit about the tax shelter particular category. I'm assuming that most of the people viewing these videos are going to be very curious about the tax shelter category. But that's the basis of the taxable category. Unless you can easily quantify and have the professionals working with you in the beginning, the harder it's going to be to fix it. So if you get into the middle age category, it's basically saying the same thing. The sooner you can get it done, the better you're going to be framed to be able to take actions when circumstances in life will change your thinking or the opportunity prevails to sell.
Yeah. All that more reason to engage your professionals early and often. Well,
and to have the planning tool to be able to assess it.
Yeah. Well, thank you, Mike. And thank you for that teaser too about the upcoming videos when we talk about tax shelters and trusts as a way of counteracting some of the tax liability that can exist in the taxable category. So any last thoughts on this category?
Well, I think what's important to note, and I think some of the viewers who have watched the other videos are probably recognizing, it wouldn't be a bad idea that since we've identified what falls into what category, we've already talked about the tax qualified, tax deferred, the non-qualified, tax deferred category. Now and the tax exempt category. We also now understand what's in the taxable category. It would be a good idea with your professionals to start to, put into the particular tax categories where you are currently to see what kind of proportions you have. And that, I think that's the one thing that people don't do often enough. It's a no-brainer to talk about diversifying your portfolio from an investment portfolio, and maybe you're out of weight with between stocks versus bonds. And again, your real estate might be something where you're out of weight with where you want to be positioned between different types of real estate. And if you're big on acquiring and building businesses, to what degree do you want to diversify the businesses you own so that you're not constantly counting on market conditions in any one of those categories to succeed in building your wealth or keeping your wealth? So I think the key is allocate, put into the categories where you are right now. Have a look into the future for what that would mean when you're ready to do something to sell off those holdings and what you're likely to sell off on holdings, or whether you create cash flows from the holdings. Some people have real estate and businesses. Trust me, they'll turn around and I'll just live off the real estate income. And then they suddenly start finding there's all these expenses they got to pony up to pay, where the net out of pocket for what they get might be diminished because of unforeseen repairs, circumstances, et cetera, et cetera. And typically people get tired, even if they hire a third-party manager to manage real estate, for example, or even businesses. Sometimes they just, like I said, something clicks in their brain and suddenly say, I think I ought to be thinking about getting out of this to some degree. That's the key. Put in the different categories where you are now, work with the professionals to put together a long-term game plan that you have an education from the people who are most likely to help you the most to know, and then start to reframe as you go along to allow you to do some of the strategies.
Wonderful. Great advice always. And thank you, Mike, for being here today. And please join us, everyone, for our next set of videos.
That's the can't miss section, because we're going to take a look at, I can't emphasize this enough. People are going, well, you talk a good story in these different categories. You haven't told us exactly what it is we can do. And, obviously we're not going to tell you exactly what to do because you need to confer with professionals. But I will say this, the next category is a must see, because then it's going to open your eyes up more and you'll be able to say, oh my, I need to call my professionals right away and see how I can start to organize myself to see where I stand and what I can do.
Thanks so much, Mike.
It's been a pleasure. Thank you, Rebecca, and everybody else. Take care.